All right, hello everyone, and thank you for joining us. My name is Brad Long, Managing Partner and Chief Investment Officer here at Fiducian Advisors. For those of you that are familiar, we put together content each quarter, usually called Quarterly Considerations. That is a document that we will share with you if you're a current client, if you work with us through a financial institutions practice that has robust information across asset classes, the economy, market, etc. Today, we're really going to dive into Q1 and pull out some of the key themes that we saw in markets, utilize a lot of the content we've pulled from quarterly considerations, and then reconcile that with our current thinking on how we entered the year from our annual outlook, and where we think portfolios are going and how we're currently positioned relative to those. As always, if you have any questions, feel free to reach out to your consultant, and we're happy to address them. So with that, why don't we dive into our review of the first quarter? So to set the stage, what we'll do is we'll give you a little bit of context of where prices went over the first 3 months of the year. So year to date, left side of this graph here, we have our blue boxes across fixed income, and you can see it's a bit of a mixed bag. We'll get into this with much greater detail, but this is largely the unwind of expectations from the end of the year that there was this inevitability that the Fed would be cutting interest rates. And so as the reality of that has come, and now we have past the March meeting, we sit here in April, no rate cuts from the Fed, prices have reacted accordingly, and we'll get into more of that in a moment. Middle bars here are graphs here. So this is global equity. Now, the really tall standing tower, that's US large cap equity. And guess what? The theme from 2023, right, the Magnificent Seven driving a lot of that return has really persisted into the first quarter. Over 10% start in the first quarter is a very robust start to the year, right? If that trend at all were to persist, 2024 would obviously be a very material year. Now, not a whole lot under the hood has changed, and we'll get into this more in a moment. But the Mag 7, if you look at those 7 securities year to date through March 31st, up about 13%. The rest of the S&P 500 up about 6%, so less than half, right? So still the majority of the return coming from a minority of stocks. Now, to the right of that, you have small caps, international, developed, and emerging. If you were to say, hey, small caps were up 5% in the first quarter, you'd say that's a pretty robust start. That's a good start. Or international developed up almost 6%, yet just sitting next to or relative to US large cap, it looks a bit underwhelming, but nonetheless, a pretty good quarter from those. Now, furthest to the right, emerging markets. Obviously, China has been a bit of a laggard here. Geopolitical tensions, some fits and starts with their economy. Still a bit of a hangover from property development has been a major headwind there. But you do see the likes of Brazil. You see the likes of India and other countries. Japan and developed markets has done very well, both on local and a dollar return basis year to date. And we've seen that manifest in the first quarter. Now, as we zoom a little bit further right, we have a bit of a mixed bag across real assets. Some noise in the REITs or real estate market just based on higher, interest rate expectations driving some of the volatility in that space. Yet we did see commodities, mostly through energy and other precious metals, performing quite well for the quarter. And we'll talk a little bit about that when we get to inflation. So to give you a sense and level set, that's where prices stood for the first quarter. And a lot of this is coming in from, this kind of dual factor of interest rates, the expectations of interest rates, which went from November and December of last year, which is this inevitable cut coming, and this no-show recession, right? Everyone was certain that 2023 would produce a recession, yet here we are in 2024, no recession in sight. And so the commingling and the mixing of these expectations has really moved prices and volatility. And we saw this great cartoon from Schwab's cartoonist. And there's this saying in markets that, the Fed tends to raise interest rates on an escalator, right? Pretty slow and methodically up in a stair-step fashion, but they cut rates on an elevator, meaning they cut very dramatically and over a shorter period of time. This notion now, though, is the Fed has really pivoted to this, higher for longer stance, if you want to call it that, or maybe even taking the escalator down, right? Instead of cutting interest rates in a very material way, they might be cutting interest rates in a very modest and methodical way. And you can see, those expectations, manifest outside of the cartoonish character here, but back into markets through the CME's Fed Watch tool. So this is futures, which really helps suss out markets' expectations or anticipation of where rates would be. So the dark blue bars here is if on New Year's Eve 2023, you're asking market participants, where do you think rates will be by the end of 2024? And you can see the distribution is pretty far left, meaning a lot of rate cuts, over a 50% probability of 6 or more rate cuts, about a 70%, in the distribution that rates would be somewhere between 350 or 3.5%, 4%. Reminder, we're at 4.5 or 5.5 today. So it's a pretty material cut. Now, as the reality of the first quarter unveiled itself, obviously the distribution has done two things. One, it has shifted upwards. So the magnitude of expectation for rate cuts has fallen, though the expectation is still largely for rates to fall. And the distribution is widened. Rather than this kind of high confidence and lower rates, it's generally moving in that direction, but not quite sure when or how much. So the market is kind of backed up on that. Now, what's underlying that? Well, the Fed, has a dual mandate, right, of price stability and full employment. And so on the price stability front, this is where the Fed is primarily focused today. They've done a lot of great work, and they've gotten most of the inflation genie back in the bottle, right? We went from 9% or higher rates of inflation, down to, and this is core CPI, down to 3.8% we observed at the end of the first quarter. Now, there's a little bit of a bugaboo here with shelter. We're not going to pick apart that because we have in previous writings and conversations. But if you're actually to pull out shelter from core CPI, you actually see 2.2%, pretty close to the Fed's target of 2%. Nonetheless, the Fed is proactively saying, hey, we would rather wait a little bit, have greater degree of confidence that inflation is a story of the past, and continue to trend towards our long-term target, average target of 2%. Now, the Fed is also dual mandate, right? Price stability and full employment. The Fed has had no pressure on their second mandate. We've had a lot of economic growth. We've had 6 quarters of 2% or more higher GDP growth. That's a great streak for the United States at that level of growth. Unemployment today sitting at 4.5%. By all measures, that's low unemployment, right? So the Fed has not had to prioritize growth or price stability. They've had the opportunity to prioritize price stability, and growth has taken care of itself. Now, when we talk about GDP, when we talk about unemployment rates, a lot of economic data, right, is just by happenstance of what it is it is rear view looking, right? So as market investors, right, we don't want to try to be driving the car looking through the rear view window. We want to be looking through the windshield, right? So as we look at economic data, we would say, and again, pulling this out from quarterly considerations, there is some trends as we look at some of the unemployment data. So this is what's called the Shaman Rule. It's effectively when the U.S. unemployment trend, so current employment, if it surpasses its 12-month moving average, that movement has often preceded recession. Now, does it perfectly predict a recession? No. No such measure exists. Nonetheless, this is one of them that in the past, these, you'll see the blue line here, which is that is the trend. If it's above 0, it's above that 12-month moving average. And then you look at the gray bars, that is historical periods of recession. So by no means perfect, but nonetheless says to us, hey, there is potential for economic weakness here. But again, it gets back to, and you've probably heard this many times from us, this notion of we're not here to precisely predict when the Fed will cut interest rates or to what degree, or if and when a recession will occur, right? We accept those, especially a recession, as an inevitability, right? We invest knowing that recessions are a natural part of economic expansion and contraction. And we build portfolios that are robust and resilient enough that they survive recessions, right? We don't have to time a recession. And frankly, we don't think, nor do we think anyone else really has that precise skill. So, as we think about, what that potentially means, it means that, as we look at markets today, there's a lot of investors that are sitting in cash. Actually, in money market funds today, there's $6.1 trillion with a T, trillion in cash today. Now, I know for me, trying to conceptualize some of these numbers, especially since we're talking about budget deficits, now in the billions and trillions. So let me give you just a sense of a trillion. 1 million seconds is 11 and a half days. 1 billion seconds is 32 years. 1 trillion seconds is 32,000 years. So we're talking about a lot of money sitting in money markets. Now, part of that is coming from this anticipation that, hey, there might be a recession. We don't know, but we could potentially wait it out in cash. That's market timing. That's not something we would advise. And frankly, anyone that did that in 2023 left a little bit of money on the table. Now, as we think about also just current yields, many investors are in cash because of the current and high attractive yield. And that's true. Money markets are yielding a lot more than they have in the last multiple decades. And that's a great thing for investors. It's a great opportunity to earn a material rate of return above that of inflation without taking on lots of risk. But if you're getting back to this idea of efficiently allocating a portfolio, we'd note that, looking at today's market, right? Even if we say, hey, this Fed cut is coming and we're trying to time the Fed cut. Again, that's not what we're seeking to do. You can look at from the point of a Fed rate cut, looking 12 months forward, 1 year forward, stocks and bonds are, on average, they're kind of a push, right? They're pretty close to one another. Obviously, bonds, you take on materially less risk. And you can see from these rate cuts, in all of these instances since 1995, you have a positive rate of return. Now, there's clearly no guarantee that that would happen again in the future. Whereas when you look at the S&P, you have the range of down 20 to up 23. So the ability to access an asset class with call it a similar potential level of return to equities without taking on, as much risk is certainly attractive. And then obviously bonds versus cash here, in many instances, especially in a falling rate environment, bonds tend to be more attractive from a total return perspective than cash. Now, this is kind of dusting off that idea or putting a little bit more specificity to it. Looking at this idea of asymmetry in return and fixed income. And one of the reasons that we had, moved portfolios towards high quality US investment grade fixed income. So interest rate movement. If interest rates go up, prices fall. If interest rates go down, prices rise. That's how bond math works. And so you can see the dark blue bars here are, hey, if interest rates rise, this is the potential price fall. Now, the middle box here, the Barclays US aggregate, that's kind of core investment grade US bonds, the S&P of bonds, if you will. So if interest rates go up, yes, there could be a loss of capital, 1.4% based on that estimate. And that's not great, but that's also not, a huge downswing. Whereas if you saw interest rates fall by 1%, then you could see, really an equity-like level of return, 11% rate of return, potential. And that speaks to kind of this asymmetry, right? The downside versus upside in some of these securities. And one of the reasons that we're seeking to own more high quality investment grade fixed income because of this differential. Also, when we kind of juxtapose this opportunity set relative to equities, our 10-year forward-looking capital market assumption for equities is, call it around 6%, right? So the difference between what is the current yield or forward expected return on fixed income and US large cap equity, there's not a whole lot of space there, but there's obviously a very different level of risk. So that's been one of the key themes and discussion points of where the market is trying to find its level as the discussion around interest rates continues to evolve. Now, shifting to equities, as we mentioned, kind of that, the gap between fixed income and equities. So equities, as we mentioned, had a really great first quarter. US large cap, obviously continuing to rule the roost. Now, the S&P 500 currently trades at 21 times forward price to earnings. What that is that's a metric for relative valuation. The idea being, if it's a lower number, that means it's more attractive from a valuation perspective. It's a higher number, it's less attractive. And 21 times is higher than historical averages. On over 20 years, historical average is right around 17. It's important to note, though, that there's a pretty big gap in difference between some of the underlying constituents. So the top 10 securities in the S&P 500, so that's the Mag 7 and a few, trade at almost 30 times forward earnings, whereas the remaining trade at 18, or about historical average. So all three of these numbers above historical average, but a lot of that is being driven by a handful of securities that we've talked quite a bit about in the past. And so why do we look and kind of pay attention to valuation? Over the long term, valuation tends to be very meaningful, but you can also bucket into kind of some of the shorter term inferences of meeting long-term objectives at current valuations. For example, if we were to look since the 1950s and just break out the forward 12-month return at different valuations, right? So less than 10 times, 10 to 12, 12 to 14, et cetera. You can see that, the higher the valuation, the harder it is to continue to earn an equity rate of return or even a double-digit rate of return, whereas you see the opposite as you trend lower. Now, they're not perfectly correlated, and frankly, in the short term, there can be a lot of noise between something that's very expensive and continues to get more expensive, or something that's inexpensive and continues to get more inexpensive, right? So this is not a one for one, but it does give you a sense of, at 21 times forward earnings, the S&P has some work to do to continue to produce the rate of returns that we've seen in the first quarter. So that gets us to, what did we come into the year with, right? And we talked a lot about this idea, and we've already had today, prepare, not predict. Three primary themes that would be driving markets. So this messy middle inflation, and we've seen that in the first quarter, continuing to trend down, still modest levels of inflation, but we've had fits and starts, right? We have auto insurance and home insurance rising in costs. We've recently seen energy on headline inflation moving up, right? So it's not going to be an easy, defeat of inflation, but we do think we're moving in the right direction. Getting back to this concept of prepare, not predict, right? The waiting for Godot recession that doesn't seem to arrive, right? We build our portfolios with resiliency, knowing that they are an inevitability, rather than trying to either tell ourselves or tell you all we can perfectly time them, because we know that that's oftentimes a losing game. And then, we just got done talking about Mag 7 inferences and kind of big, important, and big picture components of what that's doing and driving in the opportunity set here in the United States with US large caps, trading at nearly 30 times forward earnings. That allows potential opportunity for other leadership in equity markets, or even across markets, right? We talked about fixed income versus equities. So getting this back to where this puts our portfolios and kind of how we've positioned for the year, right? So high quality fixed income, still see a lot of relative value there, both on an absolute basis, right? The level of return it can potentially produce for a portfolio just in its own bubble, and relative to the level of return it can produce compared to other asset classes, especially on a risk-adjusted basis. We didn't talk about it today, but we talked about our outlook, and we'll dig more in mid-year. It's just kind of underweight high yield credit. So in short, we don't see the return potential for the level of risk taken there. Doesn't necessarily mean that it's it's a disaster waiting to happen, right? We just want to own less of it because we don't see it as attractive today. So we've moved those positions down in our portfolio. We still have exposure, many of our clients do. That's been beneficial year to date, but we're just cognizant of risk that is mounted there. Small caps, again, strong quarter, but not a strong quarter relative to large caps, driven by those Mag 7 securities. Still, a lot of opportunity there we see outside of just a hand full of stocks. And that story continues also apply to, securities that, live outside of the United States, right? The global investment opportunity set does not live between California and New York. And we think there is and continues to be a lot of opportunity. And we've seen some of that manifest in countries like Brazil and Japan. Japan had a really great first quarter. And then finally, just coming back to this mantra of prepare, not predict, right? We know that market volatility, it happens. We know that recessions are an inevitability, right? So building our portfolios in a way that we can live through kind of those periods of inevitability and hopefully take advantage of some of the opportunities, whether they be from a return perspective and leaning into, a risk perspective and leaning away from, but preparing for those moments in time, not trying to predict in time. With that, we really appreciate your time. Thank you so much for joining us. As you said at the outset, should you have any questions, please feel free to reach out. We're always happy to help. Thank you so much for tuning in, and we'll see you next quarter for our mid-year outlook.